Hello everyone, chessNwine here. I know it's the middle of the trading session right now. We're coming up on 12 o'clock noon East Coast time. But I really would like to show you this chart here. This is the SPY. It's an ETF of the SPX, the S&P 500, I should say. Normally I use the SPX, but I want to show you this SPY ETF today. And before we even get to the price action, what I like to first do, a good exercise to do when you look at any chart really, is to forget about the price and instead take the volume bar all the way up and look at the volume and just get a big picture perspective. And you want to ask yourself, within the context of this certain time frame, again a 30-minute chart, and we're looking at basically the last two and a half weeks of trading here, who has the initiative more so, the bears or the bulls? Who is buying or selling with more conviction? Now, in terms of quantity, in terms of the amount of volume bars you're seeing, it looks to be about even. Maybe the bulls may have a slight advantage there in terms of the quantity of the volume bars, but in terms of the potency and the conviction with which people are buying or selling, the bears clearly have the advantage there. You see these massive red candles here, and I recognize most of these were kind of seemingly news-driven events surrounding Goldman Sachs and Greece within the past 2 weeks. Not to mention we're in earnings season. But clearly you're seeing heavy volume selling. On those days when we are selling off, it is with conviction and it is in size. And that tells me you're looking at institutions selling. Hedge funds, mutual funds, the T. Rowe Prices, the John Paulsons, the David Einhorns. It might not be them per se. Clearly it may not be them per se, but I do think you are seeing people who control some serious money there. Tens of billions of dollars, hundreds of billions of dollars. Those kinds of market players, they tend to be selling when we have these down days recently. Now, of course, you have to put it in context. You can't look at this in a vacuum. This is within the context of a cyclical bull market. Since March of 2009, we've been in a pretty steep uptrend, especially since February of 2010, within that overall overarching trend. So we've arrived at the point now where we've had a very sharp rally, both, like I said, from March 2009 and from February 2010. And now these past two and a half weeks, we've found ourselves essentially in this neutral range at the top of our rally here. And these light blue lines right here that I'm highlighting, they represent our kind of short to intermediate term resistance and support levels. And resistance would be about 121.50 on the SPY, which translates into about 12.15 on the S&P 500, and our support would be 118.50, which translates into about 11.85 on the S&P 500. So every time we've slightly dipped down below, we've immediately come back in, and every time we've tried to break out, we've actually come right back in. So that shows you the market wants to be in this range for now. Again, we tried to break down, we couldn't. So we're back in this neutral range. And so as far as price, it's a stalemate. It's in terms of the price action for now within this context. And in terms of the volume, the bears are definitely starting to seize control in terms of conviction. So you need to be aware of that. So therefore, that's one of the reasons why I've advocated having a large cash position over the past 2 weeks, in addition to the fact that I thought we were going to be in earnings. I mean, I don't have a crystal ball, but I really felt like throughout earnings season, there are so many variables. You need to have a high level of cash. So until we break out of this range either way, I really think you need to have a high level of cash. I personally have about a 15% short position in my portfolio. I am long certain select names like Smith & Wesson. But another thing to watch out for that I noted last night on Charlie and on the Stock Twitch stream and in my blog, my nightly wrap-up post, look at this. We have higher highs within this range, but we also have slightly lower lows, and that's known as a broadening channel, especially the top end of a range after our rally. You could argue this is what's called a megaphone. Okay, you see, it looks like a megaphone. These two lines right here. That's a bearish formation. What you have going on here is a heated argument, exchange with volume going on between the bears and the bulls. And when that happens at the top end of a range after you had a spectacular rally, it does tend to be a bearish formation, and eventually it's resolved to the downside. So what you want to see here, the bulls need volume and volatility to contract now, and bears, you want the volatility and the price action to keep flopping around here, because then the presumption is we'll eventually roll over. So I hope this helps. Thanks.